Let me introduce you to our special guest today, Tim Levene from Augmentum Fintech, which, if you don't already know, is the UK's only listed fintech-focused investment trust. So Tim co-founded the trust in 2010 and launched it on the main market of the London Stock Exchange in 2018. Hi, Tim, how are you?
Good morning. Great to be here.
Brilliant. Thank you so much for joining us today. So yeah, you've put together a few slides for us. It'd be great if you could just give our audience a quick summary of the trust, and then we can jump into Q&A.
Absolutely. Now I'll try and rattle through the story in about 10 minutes, giving hopefully an appreciation of where we are from a sector point of view, how that's overlaying into the macro, and then just highlighting Augmentum's journey, where we are today, and some of the key holdings in the portfolio. So if you I think you're driving, aren't you, Jana, on the slide? So if you move to the first slide there, and really this is an encapsulation of what we have seen. The markets have been on a roller coaster, in particular since COVID, and what you see here is the global fintech index, those listed fintech companies that really went on a charge from April 20 pretty much until the start of this calendar year, and they have been sold off pretty aggressively over the past 6 or 7 months. And although they've had a bit of a bounce over the summer, investors are rightly questioning how much growth they want to hold. Do they buy into the growth story going forward? And we can look at some of those kind of historic multiples relative to the multiples that they were trading at the peak of the market, and I'll talk you through that in a moment as well. I think what I'll try and do today is really kind of separate the global macroeconomic situation, and then really kind of hone in on, what is the opportunity in fintech? Why should it be an area of interest for investors to continue to explore? And where are we on that point of evolution? How far through that journey of digitization is financial services? So I think if we go to the next slide, you'll see what has happened in a more granular level, why the market really started to sell off those listed fintech companies, in particular in the US. And they started to trade on unprecedented multiples of the next 12 months of revenue. I think if we look back over time, and this is a snapshot of the last 3 years or so, growth tech companies would typically trade, and when we talk about growth in the listed space, these would be more established, slower growth than some of the companies that we would back, but at a higher level in terms of revenue. 6 to 8 times forward revenue would be the kind of historical norm. For them to be trading at high teens and at some point in the 20s was unprecedented, and the sell-off came certainly as no surprise to us. I think what we've seen is a real ski slope down, as much as a ski slope, if a ski slope can go up, from March 20 to the start of this year. And now we're starting to see these businesses trade below the kind of historic multiples. And I think the challenge for investors is to really get comfortable or not with the prospects going forward. So many have argued that they are oversold, but ultimately I think you have to look selectively at these individual assets on the listed market. When it comes to Augmentum, we are backing high growth, early stage fintechs, and I think there is always a temptation to look at the public markets, and when you mark your valuation, say, well, the public markets is trading at a much higher multiple to where we're holding them, and we should write them up accordingly. And the average growth rate of our top 10 holdings would be around 100%, so significantly higher than these listed companies. I think when you look at how we've been holding our overall valuation, I think it's really important here to show the consistency in that. Despite that the market has been very frothy at times, we've continued to remain disciplined and hold our multiples of our key holdings below the long-term listed average. Again, businesses that would be growing at a slower rate than many of our companies. And that is really important as we get into an environment that we're in now. Investors, both retail and institutional, are looking much closer at the valuation fundamentals of private equity and venture capital. And there is a real difference. I think we talk about venture capital under the umbrella of private equity, but it is fundamentally different. You know, I have been in the venture space for over 2 decades, both as a tech entrepreneur, building one of you know, perhaps the UK's first unicorns in Flutter and Betfair, and you know, I've seen a number of different cycles. But what we have now in the European and UK venture capital space, which is very different from 2000 when we had, you know, the first dot-com boom, we have an infrastructure and an ecosystem that is really deep in terms of capable investors. We also have the deepest amount of dry powder at any other point in history. So what we are likely to see, in our view, is continued and significant investment in UK venture capital, in European fintech, but at more moderated valuations and at a slower deployment pace. We were seeing funds being deployed over 12 to 18 months when typically they would be over a 3 to 4 year period. And if we're honest, we're quite happy with that, because some of what we would call tourist money that was entering the space, investors, institutional investors, family offices, sovereign wealth funds, corporates looking to get exposure to one of the most exciting emerging asset classes in fintech, were willing to get exposure at any cost. And I think they have been burnt over those past 12 to 18 months as they've looked to build that beta portfolio. Our job is to find alpha. We're specialists in the space, and frankly, you know, what we would like to see is more specialists in the space rather than those coming in and not fully appreciating the nuances of the market and ensuring that our pricing is sensible. So if we move to the next slide, I think this is a critical piece of data, and I think if you are looking at whether do I want to be a buyer or a seller of European fintech or any form of fintech, you have to believe 2 things, certainly if you're considering investing in Augmentum. One, do I believe that the global financial services industry is going to continue to digitally transform? Here you can see some of the core sectors in the space and how much they've been penetrated by disruptors. What has been pretty extraordinary over the past decade during the digitization is how slow financial services is digitized relative to other industries. So when it comes to the global revenue opportunity, we're fishing in arguably the biggest pool, 13, 14, 15 trillion dollars of global financial services revenue. So an enormous market opportunity. Yet, if you transpose these charts to other industries, you would have seen disruptors, digital disruptors, collectively holding 30, 40, in some cases 50% market share. So financial services has been very slow to disrupt. It's heavily regulated in many spaces, and that inhibits innovation. However, we have started to see some very significant businesses that have been built and are being built over the past 5 or 6 years. So the genie is well and truly out the bottle. We're well past the point of no return, and there is a long way to go. So I think structurally, from our point of view, we remain incredibly bullish and excited about the opportunity ahead. Yes, the macro environment can be a headwind in terms of valuations and share prices, but ultimately the market opportunity is there. And I think that's what investors really need to understand and believe or not, or fundamentally might believe that existing financial services Goliaths can find a way to innovate themselves. And secondly, ultimately our job as a specialist is to sift through a huge number of opportunities and identify enough winners in the market at an early stage to deliver those outsized returns that we're looking to deliver. And so if we move to the next slide, you know, the question is why, you know, should you consider the sector as being one, underpenetrated, still with a long way to go, when you have these enormous global Goliaths with very significant balance sheets, highly cash generative in many cases, and have very significant IP and capability in people and staff, and operate on a global level. The reality is they've spent the last 15, 20 years investing a quite extraordinary amount of their capital into digital transformation. And that capital has largely been spent pretty ineffectively. These, in many cases, are slow-moving oil tankers that are, in some cases run like countries or, are federal institutions, where creating innovation and changing the dynamic is very hard. And so a lot of that capital is put towards propping up existing legacy infrastructure that frankly was built in the 90s, or in some cases the 80s, that is no longer fit for purpose. And I think the shift of these global financial services companies in the last 2 years in particular has been a much greater acknowledgement and willingness to, one, work collaboratively with fintechs, and B2B fintechs in particular, that can help solve some of the problems that they've failed to solve themselves through building their own tech at a huge cost over the last 5 to 10 years. And secondly, they are becoming increasingly acquisitive, and we've seen that in particular with the payments companies, which is probably the most established and disrupted part of financial services, where the likes of PayPal, Visa, MasterCard have been spending very significant amounts on strategic acquisitions, partly because they want to acquire the technology, and partly because the threat of their competition acquiring this technology is so high that they're willing to pay a very significant premium. So when you think about what are the exits for a lot of these fintechs across Europe and beyond, yes, we can all look to the IPO markets, which are unlikely to be particularly active over the next 12 to 18 months. But if you look over the last 5 years, 95% of all M&A and exits have been through either strategics or later stage buyouts, private equity buying. Only 5–6% have moved to IPO. So that very much is your exit route. And we believe that these large global institutions will continue to invest, yes, on their own balance sheet, but two, they'll continue to invest directly in fintechs, and will become increasingly acquisitive over the coming years. And there itself presents the opportunity for and the exit route for many of these fintechs. So if we move to the next slide, let me just hit the highlights of Augmentum. So where are we? We've been listed for 4 years. We've been on a journey. We've listed with around 90 million of NAV. That's grown through NAV growth and also through further issuance. And, in and around 300 million, I would say we're at that first meaningful point of scale. The internal target for us as a team is to deliver that internal rate of return each year of around 20%. That would put you in the top decile. Now, ultimately, what you need to do over time is to deliver that set of realized returns, which we're starting to do as the portfolio starts to mature. But this is kind of blended across both the unrealized and realized. And as importantly, in this market, we're well capitalized. So we have been less active than we have been previously over the last 12 months in particular. But that's largely because we felt the market was very expensive. We were seeing a lot of compelling companies to invest in, but they weren't particularly compelling investment opportunities. So we often talk about in our investment committee, these are great potential companies, but these will be terrible investments at the pricing and the terms that are being offered, and we're not prepared to step into them. So fundamentally, we think the market will come back to us in terms of more reasonable pricing. We're prepared to be patient. Ultimately, we'll start to see that market come back, in our view, in Q4 and Q1. And so we're excited about the number of opportunities that are coming our way, but also hopefully more sensible pricing back into the market. So if we look at the next slide and how the portfolio is spread, ultimately our investors want to see diversification. They want to see diversification across a number of those subsectors that present the biggest single opportunity in financial services. And you can see here over the 4 years, we've really kind of honed in on a number of areas. Digital banking and lending has, of course, been a huge area, in particular of those business to consumer businesses. And we're seeing some real kind of very positive cut through from some of those businesses, but also the wealth and asset management space, where we had a fantastic exit with Interactive Investor earlier this year, which Aberdeen bought, and that presented 11 times our money and I think about an 87% IRR on the initial capital that we put to work. So that is an area where we see a lot more opportunity over the next 5 years and beyond. It's a huge revenue pool to attack. Incumbents have been very slow to digitize. Consumers have had a lot of inertia about switching, but we believe over the next 2 to 3 years that presents itself a really exciting opportunity for investors, and we're spending a fair bit of time continuing to build exposure, but also looking at the next generation of wealth tech businesses. And then across infrastructure as well, what we would define as B2B businesses that are helping both fintech scale, but also working with existing incumbents, which I talked about earlier, that have spent hundreds of billions collectively over the past 10 years trying to build their own solutions, and are recognizing that they cannot solve their own problems, and are increasingly working with these B2B fintechs to help the digital transformation. As importantly, and if we flick to the next slide, it's a question of, it's not just good enough to have diversification across sectors, subsectors, but also by stage. You can't have 24 early stage businesses in the portfolio. They take a long time to come to maturity. Inevitably, this is a risky asset class, and you want to make sure that you can make enough bets in order to double down on those ones that are starting to prove out their hypothesis. And so what you have is a well-balanced portfolio where you've had companies that have come through, really started to perform, and we've continued to invest and support them on their journey. So that's very much the plan, where you can see you have the bulk of companies towards the earlier and mid stage. And even those late companies, you can see the growth rates here to the right are still growing very nicely, but we would expect the path to exit to be within a 2 to 3 year period. And that's really important as we continue to maintain the portfolio construction. Yeah, jump in, Jana.
Sorry, Tim. Just while we're looking at the portfolio on our screens right now, we've got quite a few questions about this. Given the environment with rising inflation and interest rates at the moment, of course, financials tend to do well in a rising interest rate environment, but can you say the same for fintech? Where does fintech stand in this kind of situation?
Yeah, I mean, I think it very much depends on the type of fintech business that you're focused on. We have some businesses with lending exposure, so the likes of Zopa, which has been around for a long time, has shifted strategically from a peer-to-peer lender to a fully fledged bank, which happened about 18 months ago. The business is trading very well. It's publicly put out some very compelling numbers. It knows how to in their view, lend very effectively. It's gone through one crisis in the past, so it's kind of built up that data set over a decade and beyond. And we believe that businesses such as that will continue to trade well. They understand how to price risk. They've built a very strong origination engine. And I think on the SME side, the likes of iWalker as well have been around for a while and have built that, very much kind of data-driven risk pricing engine, and should see some real benefit there as well. So I think we can look very specifically at certain businesses that would thrive irrespective of their underlying growth rate in a recession. But also, if you look at the businesses that we've backed, you can't be flippant and say, well, irrespective, they're recession proof, but these are businesses fundamentally disrupting very traditional subsectors within financial services, where in many cases consumers or businesses are demanding the services the incumbents aren't providing. And as such, you're seeing kind of significant switching move across. I can give you the example of Tide, which has created, an SME digital banking platform that has grown since we first invested from less than 1% market share of the SME banking space to nearly 8% today in the last kind of 3 years, which is a pretty extraordinary growth rate, and has well north of kind of 400,000 small businesses on its platform. And I think the question we're often asked is, well, how will they navigate a recession? There's not a lot of balance sheet lending there. But I think if you look at previous recessions and you look at company formation, then that is really a moment where you start to see a real spike in company formation. And we saw it in 2008, we saw it in 2000 as well, and we would expect to see a continued spike in company formation and Tide are very well placed because that's very much their target audience, which is micro and small businesses and sole traders, where they provide, almost, you can register your company and get a bank account in parallel as well. And that's very kind of compelling for that market, which the large, SME banking platforms, the NatWest, the Barclays, the HSBCs of the world simply do not want to open these accounts because they do not have the infrastructure to be able to serve these small customers profitably. There's too much cost in their system, and we can run a much more nimble and dynamic business at a much lower cost to serve than the big banks.
Well, thank you. And given this sort of impending economic storm, so to speak, do you think the UK is still an attractive place for your trust to invest in?
Absolutely. I mean, I think for us, we are backing UK fintechs that are serving a global audience, so either consumers or businesses. We invest across Europe. If I think of our last 6 or 7 investments, 6 of the 7 have been outside of the UK. So we've invested in Finland, in Sweden, in Germany, in France, in Estonia, and Israel, amongst places. So there is, an excellent cohort of companies across the European fintech ecosystem. If you look at the amount of capital that has been deployed in European fintech over the past 3 or 4 years, then about 50p in every pound invested across Europe has been in the UK. But I think it's important to distinguish, what does UK fintech really mean? The UK remains the premier place to build a pan-European, a global fintech, because we have a regulatory regime that has been regarded as forward-looking and progressive. We have a central bank in the Bank of England that has embraced digitization and innovation, and we've had successive governments that have recognized the opportunity that fintech brings, the competitive advantage that the UK has in financial services, and they've really built on that over the past 10 years. Alongside that, when that pool of capital arrives, and we have, as I said earlier, we have more capital now in our UK fintech and tech ecosystem generally than any other previous point in history, this is the place where fintech founders look very seriously about building and scaling their fintech, which, irrespective of the the global market conditions, gives us real heart that the UK and London in particular will remain that center of gravity for fintech, not just in Europe but globally as well.
Brilliant, thank you. We've got a question here. Given that the big banks and insurance companies appear to want to become landlords, is there still the impetus for fintech from these sources to provide sufficient opportunities?
Sorry, could you just repeat that question? Just want to make sure I understood that.
Given that the big banks and insurance companies appear to want to become landlords, is there still the impetus for fintech from these sources to provide sufficient opportunities?
Well, I think you've just got to go back and you can look at the slide I put up earlier in terms of where we are on the journey by sector. So I think the opportunity set for fintechs is remains enormous. We only need to look at, even if you look at payments, which is the most established, we continue to see just a swathe of innovative payment companies looking at the full value chain of payments, looking at how many of the traditional businesses are taking a cut along the way, seeing significant opportunity in both reducing the margin there and taking a share of a very rich kind of revenue and profit pool. So I think from our side, the banks, even though they ultimately could become acquirers and investors in many of the portfolio, you want them to remain kind of fat and happy, and perhaps not quite as focused on the threat that is and has been presented over recent years. I think, as I said earlier, there is a growing recognition amongst the global financial institutions that they simply cannot innovate from within, and that is where you will see the M&A stream continue to play out. I think the question is, if you are a fintech, do you want to be acquired by a traditional financial services player, or do you want to continue to compete with them head on? And don't sell too early. Ultimately, there are always opportunities to sell on the way. Yes, you can't be greedy, but ultimately, if I look at some of our portfolio companies, and I can give you a very specific example of Interactive Investor, ultimately it sold for 1.5 billion pounds when we initially invested many years back at a 20 million pound valuation. I'm sure there were many opportunities along the way to sell that business, and not to say that maybe we should have sold at 4 billion or 5 billion, but ultimately it presented a very good return at a good time for investors that were looking for liquidity. And I think that kind of was ultimately a good example of making sure you built a really strong business, and in the point in which you were looking for that liquidity, then there was plenty of demand from investors to look to acquire that business.
And what are your thoughts on crowdfunding? I know a lot of startups, especially at the very early stage, tend to look at that to begin with.
It is a useful additive tool for early stage businesses to complement the amount of capital that they can bring in at a particular stage. Ultimately, what I would say for a company that is looking to Seedrs or Crowdcube to enhance the round that they've put together, if I'm an investor and I have invested on these platforms as an individual investor in certain companies, you are looking for external validation from an experienced investor who understands the asset class, can sift through the thousands of equivalent opportunities to say, why is this particular opportunity compelling enough for us to look at? And without that validation, I would look a lot closer to understand why has a professional external venture fund not decided to come in, and why is this company looking only to the crowd for its capital. I think there are reasons as to why that happens, but I think that is the exception to the rule, and that would certainly be, from a personal point of view, as a retail investor, I would be kind of a bit of a red flag, and I'd really want to dig in. But they're very useful platforms, and they're a core part of the ecosystem, and they provided several billion pounds of capital alongside venture in the past kind of 10 years, and we hope they continue to thrive.
Sure, thank you. Andrew mentioned Chrysalis earlier in the show. We've actually got a question asking if you think that the share price performance of Augmentum Fintech has all been influenced by the share price performance of Chrysalis.
It's a good question. I can't know for sure. I mean, I think the whole private equity and venture capital sector has seen a sell-off. We are trading at a very significant discount to what we usually have done previously. This time last year, we probably were at a 20-30% premium. We're trading at about a 30% discount. I think it's ultimately investors are looking at the underlying portfolio. They're looking at the public market comparables and saying, do I buy into the underlying valuations that you are reporting to the market? And we recognize that there's been a shift away from growth into yield, and we were listening earlier to, I was listening intently to a very different world of kind of yield producing. This is certainly not a stock for widows and orphans, but ultimately for us, what we've tried to do is make the valuation methodology more transparent. The slide I showed earlier on the multiples in terms of our top 10 holdings, which account for about 70% of the NAV, the average forward 12 months revenue, and I think that's all we can do is continue to put the runs on the board, continue to value fairly and conservatively, and hopefully on the side of conservative rather than aggressive. And I think if you look at Interactive Investor, where we had pretty good visibility that there was a high likelihood that there would be very significant interest and it would sell, and arguably at a higher price, even when we put our interims out in November of last year, and I think the deal was agreed with Aberdeen in December, we still put that with an illiquidity discount, and the ultimate sell price was at a higher price. So we'd rather surprise on the upside than the downside, and I think that was a good example of continuing to moderate valuation, even though investors rightly said, we feel you hold that a little bit under market. And we said, look, we get it. But ultimately, until we have a firm offer, what we're not going to do is put a price which is hoping for the best case. So that's very much I think the challenge that both retail and institutional investors have at the current time is getting comfortable with the underlying valuations. We're trying to articulate as best we can that we feel that the portfolio is fairly priced at the NAV of 155 and trading at about 110. It's for investors to go away and make their minds up whether they think now is the right time to buy. Ultimately, though, a lot of our retail investors will be holding this through ISAs and SIPs, fundamentally believe in the long-term nature of the opportunity of fintech, and hope that our diversified portfolio of fintech companies can bring those outsized returns over time in an aggregated way.
Thank you. We've got a couple of questions on specific stocks in the portfolio, and I think you've got a few slides on some of them. Can you talk to us about Grover? One of the questions says, this sounds like a leasing business that's focused on tech, which could become obsolete quite quickly. Is that a concern?
I mean, I think beauty is in our beholder. I think what interests us with this business, this is a business that is allowing the rental, in particular, of high-end consumer electronics, so smartphones, laptops, Sony PlayStations, Xboxes in particular, where the core market is Germany. There's no real business to note in the UK. German Gen Y, millennials, Gen Zs in Germany are keen to rent and not own. They want to have the flexibility to be able to switch in and switch out. And it's been a product that has generated very significant demand. It's grown exceptionally quickly. If you go to Germany and you go to one of the leading electronic department stores, either online or physically, the choices of payment are: do you want to buy this phone? Do you want to buy now, pay later, perhaps with Klarna, or do you want to Grover it? Do you want to kind of rent it over a period? And it's proven to be a product offering that no one else has put out there, and it's a business that's gone from next to no revenue, perhaps when we first invested, to probably a run rate of nearly 200 million euros. So the question to ask is, how will a business such as that trade, and can it sustain that growth in a recession? And I think the argument that's been made in a quite compelling way by the company is that consumers, even more so, will be looking to rent. Yes, they want to make sure that they have their Apple Mac or the latest iPhone, but the option of buying it outright versus being able to rent it and switch out is pretty compelling. So there's a business that we think has kind of compelling underlying metrics, plenty of growth potential, launched in the US in the last 6 months, growing very quickly there. There seems to be real demand. And I think the other point in that business is businesses as well. Businesses and educational establishments, again, and government, who might not want to put the capex to spending a significant amount of money on hardware, but ultimately for computers, working from home, that dynamic, want to be able to kind of rent on a more flexible basis. So we believe it's a proposition that is that continues to show very kind of strong growth metrics, and there's plenty of growth still to come.
Great. We've reached 12, but I don't know, Tim, if you've got another sort of 5 minutes to answer.
Sure. Yeah, very happy to. Yeah.
Brilliant. We've got another question. If you could just discuss the charging structure and performance fees of the fund.
Yes, the typical venture capital charging mechanism would be obviously a listed investment trust is somewhat unusual. They would charge kind of 2 and 20, 2% annual fee and 20% performance fee. I think when we listed back in 2018, we talked to investors and they said, we recognize that there is a well-structured and a long time benchmark in the market, but we feel the public markets needs to present better value. So we put a structure together where we would charge 1.5% on the first 250 million of NAV, and then beyond that 1%. And I think the challenge for us was to ensure that we get to scale, so we can have enough of a fee base to ensure we can retain and grow the team to have the very best people in the market to drive those returns. So we do, relative to our peers, charge under market, but ultimately we think it's the right balance for the public markets. And certainly something that if you can deliver those high teens, 20% IRR, then ultimately, I think you can stand very comfortably behind that. In terms of performance, and I think, again, venture historically has been about delivering realized returns, and that this is not a hedge fund. You absolutely need to be aligned with your shareholders. So for us, we need to deliver a minimum hurdle of an IRR of 10% across the basket of investments that we have, and we would have kind of baskets on every 2 years plus any follow-on in those investments for another 2 years. So unless you deliver that IRR, minimum IRR of 10% in realized returns, so that is cash back into that is not through marks, and you don't want to be incentivized to write up investments so you can get paid. We think that's a pretty unhealthy and unfair approach, and so our performance fee will be 15% on the realized returns if we deliver a minimum hurdle of 10% compounded over the time through realized returns. So we are aligned. We've got to deliver, and we've got to deliver on a pretty high bar, but fundamentally that's what it should be.
Great, thank you. Maybe just time for one more. Interactive investor, what's your plan for it? You've held it, correct me if I'm wrong, is it one of the longest held stocks in the fund?
Well, the good news is for investors, we did hold it, and Aberdeen have now bought it. It's completed, and it is no longer in the fund. So the cash from that return, you can see here on the far right, the outcome was an IRR of 87%. The money on invested return on invested capital was 11 times. From our initial 3.8 million. So a very good kind of outcome for us and for our shareholders, and we will look to now reinvest that. And you can see, this is one of those outlier success stories that we were talking about. Our only disappointment is not to have put more money in, but at the point in which we did, we had a much smaller fund. So ultimately, if we can deliver those types of returns, then we'll be in very good shape.
Lovely, thank you. We've got loads more questions, but maybe we can have a chat afterwards and put something together for our readers for the website another time. Thank you so much for your time today, really interesting. And yeah, thank you to all our viewers for sticking around here, going over a little bit, sorry about that. But yeah, we've got more events lined up. So coming up next, we have Joe Bauernfreund from AVI Global Trust. And as you can see, plenty more going through to November. So thank you, Tim, for joining us. Thank you, Andrew, and thank you to all our viewers, and have a lovely weekend.
Thank you, Jana.